Technical analysis is hard, and if you don't have some sort of clarity and you don't analyze the right things, you won't last in the trading game. So let me share my technical analysis process, which will help you to make better decisions when trading. You know the drill. Like, subscribe, and stick around for the full video. No matter if you use indicators or you rely on price action, you better start thinking in terms of supply and demand imbalances. You need to ask yourself some questions, and don't trade just because you see a candlestick formation or you have a signal from one indicator. Try to understand why the price is moving in a direction. What are the forces behind this movement? At its core, trading is a competitive continuous action with buyers competing with sellers, but also buyers competing with other buyers and sellers competing with other sellers. It's the relative aggressiveness of each of these groups, namely the supply and demand, which moves prices. When you look at supply and demand imbalances to trade, you are not interested in looking at it from an economic point of view. Instead, you are interested to see how these changes in supply and demand would affect price movements and the strength of the move, and to understand better whether a move is worth taking or not. So, when you look at this chart, price didn't went down because there was a double top. It wasn't because RSI was above 70. It was an imbalance between supply and demand. The supply has exceeded the demand, stopping the upward momentum and eventually making it drop from there. When you consider taking a trade, let's say you want to buy here, ask yourself why other traders would want to buy after you. What did they see? What makes them enter the market after you did? One of the key reasons that many aspects of technical analysis often seem to work has to do with self-fulfilling prophecy. The tools used in technical analysis, such as support and resistance, trend lines, major moving averages, and other types of indicators, do seem to have predictive qualities. Often, the price of a market does move in the direction foretold by these indicators. Those who see technical analysis as a self-fulfilling prophecy argue that these indicators are right only because a large number of people base their trading decisions on the same indicators, thereby using the same information to take their positions and in turn push the price in the predicted direction. What I'm trying to say is that common signals generated by technical analysis can be self-fulfilling and push the price of a market higher or lower, reinforcing the strength of the signal. If enough people use the same signal, they could cause the movement foretold by the signal. You want to find areas or levels that are universally accepted and therefore closely watched and traded by many traders. Never underestimate the importance of selecting the right time frame when you are analyzing a chart. Many new traders love to trade on the lower timeframes. I'm not saying these are bad, but the reality is that a lower timeframe analysis generates low-quality signals. As you move up in timeframes, each candle contains a greater amount of information. You should set a higher timeframe as a filter for the price movement, because let's face it, on a lower timeframe, you can't get all the information about the market. Only on the higher time frame you'll get a clear picture of the market's condition. Relevance on higher time frames means longevity on the shorter ones. If you'd asked me, the 4-hour is the perfect time frame to conduct your analysis and to find potential pockets of opportunity. You are most likely awake for 4 of the 6 4-hour candles that form each day. This means you would need approximately 30 to 60 minutes per day to apply your technical analysis. To me, this sounds much better than staying 5 or 6 hours staring at the charts on the lower timeframes. According to Dow theory, 3 kinds of trends dictate price movements. You should focus on 2 of them. Firstly, we have primary trends, representing significant price movements that can last several months or years. You often hear the term of bull market or bear market. These are the primary trends that can signify price moving up or down over long periods, Secondary trends will act as a contrarian force that moves in the opposite direction to the primary trend. A secondary trend works on a shorter-term basis and can manifest itself as a dip within a longer bull cycle, or vice versa. These are basically a short-term change in sentiment. You can see now why I advised you to go on higher timeframes. It would be impossible to find the primary and secondary trends on lower timeframes. You need to stay vigilant when conducting technical analysis. Things can change quickly, and it's essential to know the trend phase you are currently in. The first assumption in Dow theory is that manipulating the primary trend is not possible. Intraday, day-to-day, and possibly even secondary movements can be prone to manipulation. Still, the primary trend is impossible to manipulate. So why not follow it? Trading based on thin lines is like trading with blinders on. It's easy to find specific prices that have historically demonstrated their value as support or resistance, and the temptation which follows is to take a trade at that price when the level is revisited. But are the same traders who turned the market before going to be there again? Are the same market conditions present? Is the context the same? You already know it. Drawing support and resistance wrong will lead to wrong trading decisions and bad trades. When you are drawing simple horizontal lines on your charts, you'll usually find yourself in one of the two following scenarios. Price turns ahead of your level and you miss the trade, or price spikes through the level like it isn't there. To overcome this shortcoming and to improve your technical analysis, you need to start using zones instead of just single lines. This simple tip will help you a lot in your trading. Support and resistance zones will either hold or break. That's it. It's so simple. You don't have to overcomplicate things. Analyze higher timeframes, identify a key area, and then simply find your own method of determining which one has a higher probability of occurring and take action. Is the price gonna stop at the level or it will break it? From now on, consider support and resistance levels as market reference points that allow you to have some structure to your trading decisions at locations where there is potential for price movement. Once you've determined support and resistance zones that you will keep an eye on, the next stage is to watch for signs that the level will either hold or fail. That's it. For big institutions and traders with a need to fill large orders, finding pockets of enough liquidity is absolutely essential, and you definitely must consider these levels in your technical analysis plan. So, where do you find these levels? Where stop-loss orders are placed. The creation of a liquidity level comes as a result of an initial imbalance of supply and demand, which forms swing highs and swing lows. As more players take positions in the market, these are the levels where market participants will use as a historical reference to place their stops. And when the levels are then retested, a decision will be made. The outcome here can be a breakout of the level or a reversal. You need to start paying attention to several levels in the market, like the current and the previous high or low of the day, triangles and wedges, highs and lows of the trading sessions, market opens are other areas of interest. You definitely want to account for all of these elements as part of your plan. Most technicians are using lagging tools in their analysis. Whether it's a price action signal or an indicator one, if it's lagging, you will always be late behind price action. Lagging indicators can only be known after the event. Don't get me wrong, this doesn't make them useless. They can clarify and confirm a pattern that is occurring over time. But leading indicators or signals are the one you should consider adding in your technical analysis. Leading indicators give signals when the trend is about to start, whereas lagging indicators are those which follow price action. Both leading and lagging indicators have their own set of drawbacks. Leading indicators tend to react to the prices quickly, which means they are prone to false signals. Lagging indicators are slow to react, but they can also give many false signals. My favorite leading indicator is the volume, because it communicates the involvements of smart money. Volume is the fuel to cause new cycles and tells you the degree of commitment that it exists to endorse a certain up or down move. And you must always understand the environment and the conditions you are trading. If volume is going to be taken in isolation, it means very little. It's only when contextualizing recent price movements and its volume evolution, then it starts to tell you the complete story, unfolding bar by bar. Pivot points, Fibonacci retracements, divergences, supply and demand are other leading tools you should definitely add into your arsenal. There's a difference between a signal candle and a trigger candle. If you can't differentiate these two, this might turn into a problem. A signal candle may appear when something changes on a chart. Maybe the momentum switched, or there was a break of structure, or there's some sort of divergence. Something changed in the recent price action. A trigger candle is a candle which occurs after the signal one. Many traders fall into the trap of using the signal candle as a trigger, and this is the main reason why you take bad entries. A lot of false signals happen because there's no distinction between a signal and a trigger candle. For example, you see a good rally to the upside, and you have a pullback, and you're looking to get long, and you find this pin bar with a large wick, and you consider this as a trigger candle, and you enter, and then you're stopped out. But that was a signal candle. It told you that bulls aggressively entered the market, that something might happen, but that wasn't an instant buy. The trigger candle still has to occur for you to enter the trade. A trigger candle could be on the break of the high or at the close of the next bullish candle if it's validated by volume. Or you have a break of structure with the market switching from higher highs and higher lows to lower lows and lower highs. This is the signal the trend may be changing, but this is not the trigger you need to enter a short trade. You need other candles to confirm this, so make the distinction between these two candles. Technical analysis can be complicated by the so-called market noise. This term refers to random fluctuations of the price, those that don't have any logic or volume behind them. Market noise is simply all of the price data that distorts the picture of the current trend. This includes mostly small corrections and intraday volatility. As a result, it's only natural to be in a constant search of ways to reduce the market noise, to make its detrimental impact as small as possible. The market noise is in an inverse relation to the degree of the time frame. The bigger the time frame period of the chart, the calmer is the price. For example, we talked earlier, the 4-hour chart can provide a better understanding of the overall market situation than the 5-minute time frame. In other words, the right choice of a time frame helps to remove the market noise. Next, you need technical tools that may give you an advantage dealing with market noise. These tools will help to focus on the trend and track it for a longer period of time. The first tool that comes to mind is also the simplest one, the moving average. The bigger the moving average period, the bigger the range of fluctuations. Heikin-Ashi chart is another tool to filter market noise. Renko chart is another alternative. Your job as a trader is to have as fewer data points to look at to make the decision. You don't want to be confused by the noise. That's why try to reduce it as much as possible. Now, if you want to learn more about technical analysis and the main problems no one is talking about, make sure you watch this video and check out our Academy program if you want to further level up your trading. Until next time.